one of the best oil traders ever, what the last week has been like.
Well, I've been involved in a lot of, how should I say this, crazy times in the market. Silver in the 80s, crash of 87, the coffee market in the 90s. I don't know if everyone remembers when James Baker, during the Iraq crisis, had the word regrettably, and that was created complete panic in the oil markets. I've watched ERCOT power prices go from $30 to $2,000 in an hour and a half. But the last 2.5 hours on Monday takes the cake. You know, what happened when May crude oil went from basically, you know, at noon $10 to negative, you know, $40 in 2.5 hours. I've never experienced anything like that ever.
So what are we to make now of where we are? Do you think prices bottomed? Is there more pain ahead? How would you assess the oil market and oil prices right now?
Both. I think in the short term, with USO becoming a closed-end fund, for lack of a better word, and the June expiry of crude oil not till the middle of May, you're going to see a lot of volatility, and probably because of because USO has basically been sidelined from front-month crude, that's why you're seeing a jump in the market. But eventually, depending on how far we get in terms of how far the market goes up, when the next month crude comes off the board, which is going to be in the middle of May, we may have a repeat of the same crisis that we had last month. I mean, no one has priced in, I don't care what anyone says, negative prices into their option modeling. You know, so again, if all the banks that sold puts to Mexico, do you think they really took into account negative pricing? Do you think it'd be like the equivalent of, you know, John, if you're trading GE puts, I'm talking to John Nigerian, that's trading $6, and then all of a sudden one day you wake up and find out that GE can trade negative. I mean, there's going to be a tremendous amount of volatility in the future space for the foreseeable future.
But you think we could have seen a near-term bottom earlier this week?
Yeah, we did. I mean, how does a market bottom? In '87, if you didn't have a lot of money in your account, right at the bottom, clearing firms wouldn't let you trade S&Ps or NY futures. 2 days ago, clearing firms put out a notice in energy that unless you had millions of dollars in your account, they wouldn't let you trade front-month crude oil. I mean, so again, you know, these one-off situations, hopefully, definitely creates, you know, bottoms. I mean, the market's rallied from $7 to $17 in 4 days.
So if you think, though, that this volatility continues, though, and we could have, in your words, a repeat of what we saw the other day, what's the best strategy right now to make money in the oil complex?
In futures or in equity land?
Both.
In futures, I think that you have to be nimble. I think you have to look for overextensions, either people getting too crazy to the long side if the market gets back into the 20s, or if people go ahead and what happens as we get to the moment of truth, which will be the last 4 days of June futures before they go off the board in the middle of May. I think also that the buy the dip mentality is gone in energy, which may lead to, as you can buy the dip in futures. I think in energy names, you're seeing I think people have the misconception that no one really cares, the long run, what the current price of crude oil is when it looks at the price of BP or Exxon or anybody that has sustainable assets. Because they're going to be the winners, because anyone that has money to go ahead and buy all these companies when they go into bankruptcy or when they go into receivership or whatever else happens, they're going to be able to buy this stuff on the cheap. Besides them, I mean, the second derivative of that would be the Mark Lazarus of the world and the Blackstones that have a pile of cash and just waiting for, half the energy world to just fall apart.
John Nigerian, he mentioned your name, did Mark Fisher. I'll let you in.
Oh, well, thank you, Scott. Fish, you were invaluable with your insights over the last 3 days. He's been just so generous, Scott, to share those same insights he just did with our viewers about what's going on here. And when you see that going into negative territory, Scott, that's one thing that was a shocker for me because I hadn't seen it before. And his counsel, his advice and counsel certainly helped walk me through what would have otherwise been a huge loss. But one of the things that he mentions here, Scott, is this negative pricing, that basically you and I have always said a put option, if you're short that put option, it can only go to zero. And that's something that virtually all of us have always priced in. And now Fish is 100% right about this. Can you really draw that line and say it can only go to zero? Don't you have to build your model out so that it's a little different? It can go below zero. And I know we're talking about commodities here, Scott, and commodity options, but there are some circumstances under which you could see a stock go negative as well. Now, we're not saying, oh, this particular stock or that. I'm not speculating on that. I'm just saying if you're somebody who's always said it can only go to zero, Mark Fisher's telling you, and you should listen, it can go below zero.
I mean, Mark, do you feel like we've had this, it's like a black swan event for crude oil we've had overwhelming amount of supply made worse by Saudi and Russia doing their dance in the last, month, furthered by the coronavirus. It is a black swan event, really, on both supply and demand. How does it fix itself without a vaccine for the virus? I mean, that's a ways off. Are we looking at that long to wait before we have a more reasonable oil market?
I think in terms of oil demand or any demand, the biggest risk, I mean, I've listened to your panelists for the last half hour, but the biggest risk to me in terms of the market in general, all markets, crude oil market, the stock market in general, is if when we open up the economy, the consumer doesn't show up. So everyone's talking about testing. But if I get tested, but I'm not sure, Scott, that you got tested, if there's not a verification model along with testing, who's going to go out and go to the mall? Who's really going to go shopping? Who's going to do anything? Unless you know that the person 6 feet away from you or 10 feet away from you in the mall has also been tested. So I think that there's got to be not just testing, which is a monumental Herculean task to get done, but a verification system where, like an ID card system, on your smartphone, some kind of system that people will know that that this store says, okay, you can't come into the store unless you've had a test. I mean, otherwise, the biggest fear for me is that for oil, for everything, is that things open up and nobody shows up.
Yeah, well, in that environment, what's a reasonable price in your mind for crude? Like, what should we be trading at? Right, Jeff Curry from Goldman. His note is read routinely by I know you and others who he's like $20. What's reasonable in your mind?
Reasonable is a state of where we are at the minute, right? So reasonable in the next week versus reasonable in the next 2 weeks. I mean, reasonable now, I would be buying a dip below 15. I'd be selling a rally above 20. As we come closer to expiration, that becomes a much bigger dance in terms of where we are in terms of how much storage is taken in cushion and what really goes on. And reasonable in the stock market, I leave it to you guys because I have no idea.
Yeah, no, I wanted you to just opine on oil, and I'm really glad that you did. What about natural gas? How should we be thinking about that today?
Well, if you look at the interesting thing about natural gas is natural gas could be the biggest beneficiary of, and everyone knows this now, of the shut-ins of crude oil, because obviously crude oil produces a lot of associated gas, and with that associated gas, being depleted, if there are shut-ins, obviously this makes the curve out in Cal 21, 22 in that gas look a lot more attractive. And you can see it because if you look at the natural gas stocks like Southwest, RRC, these are all up 20% on the year. Forget about 20% for the bottom. They're up 20% for the year. And so, again, is it going to be reality? Is really that much oil going to be shut in that it's going to have such an effect that we actually could create a shortage of natural gas because of shut-ins in oil? The market will tell. But to me, it's just another opportunity to trade.
Josh Brown, you have something for Mark Fisher?
Yeah, Mark. So the trading side, I understand, and people like yourself who trade oil must be seeing opportunities every day on both sides of the trade. From an investment standpoint, specifically thinking about oil equities, they're now only 2.5% of the S&P 500, and it seems like they're shrinking by the week. To the point where they almost don't matter. I'm starting to look at these companies almost like they make typewriters. Like, if you think about the secular headwinds for oil, like, how could you invest in any of these companies? Capacity is expanding. It's never been cheaper to find more oil and get it out of the ground. There seems to be an unlimited supply here and abroad. You've got the battery threat for automobiles, which is probably 5 years out. How could you own any of these oil equities?
I leave which equities to own to you, Josh, rather than me, because I'm not really an equity specialist at all. But in terms of that, no matter what you buy, even if the environment is becoming a dinosaur, like you're saying, if you're an Exxon or if you're a Chevron and you're able to buy assets so cheap relative to any type of value, and especially because on a negotiating point of view, if I was one of the big majors and a couple of big names go under and I can buy them in bankruptcy, I'm going to make the same point you just made. I'm not paying more than X because of just what Josh Brown just said.
Yeah.
And so there's still a return to be made. I mean, whether oil is trading in the long run $20, $40, $10, right? The argument you just made is why these companies and why, like all these private equity companies, are going to get deals of a lifetime just because of the fact that the long-term outlook for energy is so bad.
Hey, Mark, I appreciate you being with us.